All right, folks, listen, it's been a real tough month for investors. First of all, the groundhog saw its shadow, right? Then AI cast the shadow. And little really can prepare you for what we've been seeing, particularly with software and some of these other names, except maybe experience. And no matter what, even then, it can be a painful lesson. So we're lucky to have two of the best on the street, Solus Alternative Asset Management. Their managing director, Dan Greenhaus, along with Alpine, Saxon, their chief market strategist, Sarah Hunt. Sarah, so you wrote that this has been a long, strange week.
It has. It absolutely has. And I think that the fact that you've got this massive move and rotation, even though the indices don't reflect that so much, makes it very difficult when you're watching every day to see these big moves up and down and a lot of volatility that you're seeing sort of across the board and moving from sector to sector.
I can tell you, Dan, even though, again, on the surface, maybe you don't see it as much, but a lot of investors have been calling me up, and they've done extraordinarily well. They've had a hell of a run, but they're like, what's going on?
Yeah, listen, them and everyone else. But I think to Sarah's point, and you alluded to it, under the surface, there's been an enormous dislocation, a shift out of technology into things like consumer staples and energy, but the broader markets are still at a high. I think the main question people are asking is that bullish or bearish? Perhaps the indices are ignoring a pretty large sector like software selling off as much as it has. I take a different view. I think it's pretty bullish that a sector as large as software, call it 8, 9, 10% of the index, has basically imploded, and the broader markets are where they are. That is the genius, if you will, of index investing, if you will. And so I take that pretty optimistically.
Yes, sir. I tend to agree. And listen, for the last couple of years, the big complaint was that 10 stocks are 40% of the market. Right. So the argument was always, can you pass the baton to the 493 and have the other ones just kind of tread water? Because whenever you look at that heat map, those big square boxes in red stand out. Mm-hmm. There have been times when the markets, the breadth has been phenomenal. But if enough of those names are down and they're down enough, the market is down, but that hasn't been the case.
No, and I think you've seen outperformance from the equal weight, to your point. I think that there's a lot more going on, and I think people are moving from, here was a story where you had fantastic cash and cash returns, everybody was asset light, this was a great story for a long time, both on the software side and for some of the mega cap stocks. Now they're spending a ton of money, you're questioning whether or not those software revenues and cash flows are going to be maintained, and that's a big problem for a lot of them. So there's a lot going on.
Why do you think all of a sudden, okay, I guess as long as they were using these hyperscalers, their own cash, free cash flow, whatever, why though the fact that they may be borrowing money, is so scary? Is that because it reminds people of the dot-com era? I mean, a big part of our economy is people borrow, people issue bonds. Why can't they do that?
They can, and they are, that's for sure. And I think, listen, Oracle is an exception. It's already a little higher leverage. It's a little bit behind the other guys in terms of the investment. But I think to your point about the allusion to the dot-com bubble, it's one thing when you can fund this out of operating free cash flow, which they were for several years. It's another thing when now you're saying not only do we have to invest cumulatively $700 billion, but we're going to start asking investors to help pay for it in the form of higher debt issuance, that the markets start to get a little bit skittish. And last year was the transition, if you will, into that more debt-fueled form of growth, which is not as comfortable for investors in general as is cash flow growth.
The thing, though, on this is that on one part, okay, AI is if you borrow money and it's a greater risk, but at the same token, the same narrative is AI is eating everything. I mean, so can AI be, can it eat everything and still be a bad investment? It seems contradictory.
Right, so that script just flipped very recently, where it went from CapEx is fantastic to, oh my God, CapEx is a problem, and by the way, you're not going to have a job, and no one's going to have a job, right, because this is going to be, it cannot really be both things, although it's going to be for some industries worse than others, and for some places it's going to be better than others. I think the problem right now is that people are having a hard time discerning what that's going to be and to what level, how bad it's going to be for margins for some people, how good it's going to be for others. And so this uncertainty means a lot more volatility.
I want to look at your picks, Sarah. You've got LNG, waste management, and import. So you're not, you've always been kind of conservative, though, right? I mean, to a point, and you certainly aren't trying to bottom fish in these tech names yet.
No, I don't think so, because I think that right now there's still too many questions. I mean, if you look at some of the valuations on non-tech stocks, you're starting to see those move higher. But
yeah, staples have never really been this expensive. I know it feels like it's a haven,
Right.
But it's also an expensive haven.
It's an expensive haven, but if you start to look at things like, so for waste management, for example, that's got a moat. There's only so much garbage that you're allowed to have. There's only so much property you're allowed to use for landfill. You can't replicate that asset base. And that's something that's going to happen whether the economy is doing well or doing poorly. It's not cheap, but it also is very steady. And I look at something like Cheniere, which is the largest player in liquefied natural gas exporting in the US. There's a lot going on globally from an energy perspective. So the places like that, and Emerson, which deals with automation, has got a software component. So that stock got smacked around yesterday. But they also, 80% of their sales is much more about automation equipment and the software that goes with it. That's not the same kind of software that's going to get ripped out the way that people are concerned about, I think, in some of the other areas.
Anna, you seem very confident. You point to economic tailwinds. Yep. You like the trends. New highs, for instance, so the broadening out of the market is a positive that you said. And you, speaking of broadening out, you still like energy here.
Yeah, we're a hedge fund. Can't talk about specific stocks, but the energy space is one that we've liked for a couple of years. But to be clear, when people hear that you like energy, they think you like oil. And there's two different arguments here. One is the negative fundamentals at work for oil itself, but then there's a whole host of companies in there, refiners and even the integrated, some of the pipeline companies that have fundamentals that work for themselves. Plus, these companies have all become cash flow machines. Right. In terms of the money that they're giving back to shareholders. So you can like the energy space without necessarily having some bullish take on the price of the commodity.
Before I let you guys go, a wild card, Dan, I'll start with you. A wild card that could maybe upset the apple cart. Not maybe as much as we've been upset this week, but that can throw a wrench in things.
The answer should be and always will be the labor market. Things have been slowing down. Then we got some signs of stabilization, and the last jobs report was much better than expected. But if for some reason that labor market deteriorates more meaningfully, that throws a wrench in all the works that we have forecast.
Although the Fed will come to the rescue then, maybe?
Well, and I think the fact that you got this good news on inflation today, relatively speaking, makes that argument more possible if there's more labor. If you had a higher tick on inflation, I think that would have been a wild card that would have just added to the frenzy that was already uncertain.
Yeah, I think that CPI number probably was even better than the headlines would suggest, because a lot of people thought we were going to see a three number handle today. I tell you right now that we didn't. So I know concerns are out there, but we're moving in the right direction. Dan, Sarah, thank you both very much. Appreciate it.